yet another episode of the Retirement Insights podcast with Jim Musgrave. I'm James Anderson, and today again we're joined with our special guest, Andy Robertson, to kind of conclude the conversation that we've been having over the last, this is now the fourth part of a four-part episode that we've been doing, where we're talking about financial advisors, licenses, the designations, what it all means, what you should be asking, and how you can go about finding the right advisor for you. Today, we're talking about specialists. And you guys, as I was thinking about this topic, I was remembering a conversation that I had recently with a friend of mine who's an oral surgeon. And he was telling me about, we had to take my son in. My son cracked the tooth and he had to get the rest of it extracted out. And so we went to him. He's a good friend of mine. And I was just talking to him about, have you had any crazy cases come up lately? And he said, yeah, actually we had. We had one of a patient that came in that had gotten a dental implant done by a general dentist. And he said the problem was the person came in, the dental implant completely failed. And so we had to go in and not only fix what the general dentist had done, but then we had to redo it all. And it ended up costing the patient way more money, way more time and headache. And it got me thinking, when it comes to health-related things, I think we clearly understand the need for a specialist. I don't know that same level of understanding is there when it comes to finding the right financial advisor. And yet, it's unfortunate because picking the wrong financial advisor can be completely detrimental to the rest of your life with the income that you need and the assets that you have. And so I want to talk today about the reason behind needing to find a specialist more so than just a generalist when it comes to your financial advisor. So, Jim, let's kick this off. What thoughts do you have in this regard?
Yeah, no, I told this story a few episodes back where I was referred to talk to a couple clients, and both of them were working with advisors, and both of them were taking out far more money than their portfolio could handle. I mean, it's very obvious that they were going to run out of money. And so just like your story there, James, it's the same thing. What happens with financial situations and retirement planning is that a lot of people don't know what collateral damage can occur when they make a decision, right? Because a lot of times people will make a decision on, how to save for retirement, how to buy a house, how to buy a car, how to college. They make these decisions and move on, but you don't know what the collateral damage is going to be until decades down the road. And so that's one thing that kind of makes me unique is that there's three different types of money. There's the accumulated money, which is where everybody focuses their time and effort, the portfolio. You have your lifestyle money, which is your living expenses. But where I kind of focus my time is on the transferred money. And that's money that people are losing unknowingly and unnecessarily. And so if we can identify these wealth transfers and redirect them back to you, so now you have identified them. I've literally found money, I've added value because I was able to find money that you were losing unknowingly and unnecessarily, redirect it back to you so you have control on how to best use that money, and we didn't affect your lifestyle. So I think it's important to understand, when you're working with a specialist like myself, we have extensive training in certain areas. Just like an oral surgeon or a doctor has, extensive training because they specialize in that area. So again, I've got Andy Robertson on the call again. He's been on the last few episodes. But Andy, do you have any stories that you can tell of people who maybe in retrospect should have been working with a specialist versus a generalist?
Yeah, I've got one that I share quite often about a woman that we met. We met her after this whole situation transpired, but it really focused around Social Security. And the long story short, because Social Security is very complex, but she ultimately had been married for many years, raised a family, did not work outside of the house, so she was not fully insured, did not qualify for her own Social Security benefit. In her mid-50s, she was divorced. Under the Social Security rules, she qualified as what's known as an independently entitled divorced spouse. And what that meant simply was as long as she didn't remarry, she would always be able to collect some kind of retirement income benefit from her ex-husband in her own retirement. And ultimately, if he passed away, she could collect a survivor benefit, so long as, again, she wasn't remarried. There's only one caveat to that. Under the survivor benefit, you can be remarried at the time you collect a survivor benefit, so long as you didn't marry your current spouse prior to age 60. So I know there's a lot of moving parts here, but here's the point. She was working with a financial advisor who did not embrace Social Security, who did not get involved in understanding the impact Social Security has on the broader plan. When she was in her late 50s, she met somebody new. That person was a lifelong public servant for the state of Massachusetts. They never worked in any other capacity. They never paid into Social Security on any of their earnings. They only paid into the pension system in Massachusetts. They retired before they met this woman. They opted to take a maximum pension benefit with no survivor benefit because when they retired, they were alone. Subsequent to all this, these two meet. We meet her. She informs us that in the 11th month of her 59th year, she married this new person. And in the process, she gave up her rights as an independently entitled divorced spouse to the first spouse, and in favor of whatever she may have been entitled to from the new spouse. Well, guess what she was entitled to from the new spouse? Nothing. He didn't have a Social Security benefit. He already began collecting his pension benefit with no survivor benefit. If somebody had simply explained to her, wait 30 days, you will now be over age 60. You can marry this new person and still retain your rights to the benefits, the survivor benefits from your first spouse, she would have been far better off. And why did that happen? Simply because the person she was working with had no interest and no understanding of how Social Security worked, and she forfeited her rights. So now, if something happens to the first spouse and the second spouse, she has nothing. And all that could have been avoided had she been working with somebody who was truly a specialist. So, and I have, you would think that never happens. We've come across that multiple times. And I have 100 anecdotal stories like that where someone gave advice without any consideration for how it would impact someone else's ability to collect Social Security. And there's nothing you can do after the fact to change that.
Yeah, I mean, that's so for the listeners out there, the Social Security seminar that I give, Andy created. And there's a slide in there that kind of talks about, there's an example of a woman with, I guess, with a deceased spouse who is underemployed, age 60. And make a long story short, we have this whole example of, without knowing the rules of Social Security and divorced spouse and deceased spouse rules, by knowing these little things, we have an example that kind of showed, hey, if she just waited, if she did this, she could get this amount of Social Security, and if she deferred, she could get all this kind of stuff. So it's understanding the rules can have really large impacts on cash flow, and literally mean the difference between not being okay and being okay and running out of money. I mean, when I say run out of money, that I don't say that lightly.
Yeah.
And so I know we're kind of talking about the Social Security thing, but there's many other examples that that people realize.
Jim,
one thing
can I just interject? I think it would help to kind of bring this home, right? So remember, the surviving spouse gets to keep the greater of the two Social Security benefits, right?
Sure.
So let's say the former spouse's benefit was $3,000 a month, $36,000 a year. That's what she now will no longer be able to collect when he passes away. So what's the economic value of that? Something, the cash equivalent value, or I know you have a term that you use to kind of put that in perspective, but if someone was able to take 3.6% per year in a distribution, they'd need $1 million to deliver the $36,000. That's the value of what this other advisor completely ignored simply because they're not a specialist and they don't get paid to give Social Security advice. That's how profound the impact can be when you don't. And at the end of the day, a specialist takes the time to know all the ins and outs of all of the mechanisms that you're going to rely on to build a successful retirement income plan. And that's the difference. It goes back to, as we've talked about it many times, philosophically recognizing that, you've gone the extra mile. You weren't forced to get educated. The fact that you're a fiduciary didn't require you to become a specialist. You took the time to learn everything you could possibly absorb on retirement income planning so you could bring all of that value to your clients and truly be a specialist. It's a philosophical thing at the end of the day.
Oh, absolutely. I was just yesterday was a day where I literally had 5 meetings, and I was doing a review with a client who's turning 70 next week, and we were talking about, she was deferring her Social Security to 70, as we talked about in our plan, and many years ago, we got her into an income annuity with an income rider that we're going to kind of turn on, and she was, when I was kind of talking to her about that, is that the difference. I mean, I'm going to get kind of wonky with you guys, so bear with me. But this is a perfect example why you need to work with someone who's a specialist. When you actually have an annuity with an income rider that's in an IRA, that money has never been taxed. So you actually have the account value of the annuity, and you actually have the income, and that income is oftentimes greater than your required minimum distribution amount. So when you have multiple IRA plans and you've got income coming from the annuity, that spread between the value on December 31st and the income that you're getting from the annuity can be applied to RMDs with other IRAs. And people don't understand that. And then the client I was talking to yesterday, she's a former federal employee, so she had the TSP. So she had a few $100,000 in the TSP and was taking money out of that. And what you got to realize is that if you can't, when you have an ERISA plan, like a 401k, a 403b, TSP, is that you have to take the RMD from that plan. You cannot take it from an IRA. So the bottom line is, the conversation I had with her yesterday is that, if you continue to take money out of that TSP and receive the income, and you may or may, whether you need the money or not, you're ultimately going to be taking out more than you may need to. And so there's just one of those kind of things where people need to understand conceptually, they need to know the rules of IRAs and qualified plans. They're different. And then that's a really important thing, is that you got to be an expert on IRAs. And that's a whole different complex topic right there. The other thing is that many times there is a 20% withholding in a qualified plan, where if you have an IRA, you take a distribution, you can withhold whatever you want. So there's little, especially just in the very specific topic of withdrawing money from qualified plans, there's a lot of complexity right there that people really need to know that. And so this is, anyway, you had a thought there, Andy.
Well, I just wanted, because I'm following along, and I just want to kind of summarize what I hear you saying. So your point is, you may have somebody who fights you against the idea of moving it from the qualified plan, the ERISA employer-sponsored plan, into an IRA. And I think the point you're making is, if you do that, now all of a sudden you're forced to take income under the RMD rules from that asset and the other asset, where maybe from a management perspective it would be better to take it all from this asset, right? So your point is,
Right.
the annuity might be paying out a 7% rate in terms of the value of the contract or the overall, and you could be satisfying the RMD requirement for the balance of those assets if they were somewhere other than in the TSP. And
Right.
I just think that's fantastic, because those are the things, that's a perfect example of when we say specialist, what we're talking about. So here's somebody who's, even though they don't need the income, multiple things are happening. They're forced to take it. It's now causing, in all likelihood, more of their Social Security benefit to be taxed. They're paying more in taxes on their overall income, and all they're going to do is turn around and reinvest that money anyway, because they don't need it. Well, wouldn't it make more sense to have it all in one place where you can manage it more effectively, minimize the pressure on the capital, right? So the balance of the capital can continue to grow and fight so that the assets will last longer. And they make it difficult for you to do that simply because maybe they don't want you to get paid on those assets, right? They'd rather leave it at the TSP and let the government get paid.
Yeah, well, right. There's so many different moving parts right here, but let's kind of, so my typical client who I'm talking to, let's say they got, again, my clientele typically has, assets between $1 million and $5 or $8 million. When you get to that level, taxes are a big deal. And just understand is when you got the majority of your retirement portfolio in pre-tax qualified money, you've got to pay taxes on it whether you need the money or not. End of story. And that's where we have the conversation of, hey, Andy and James, do you feel the taxes are going up, down, or staying the same? And 9 out of 10 people are saying, I think the taxes are going to go up. I said, okay, Well, would you rather lock in the taxes at this current rate, or would you rather risk taxes going up in the future? By the way, the Tax Cuts and Jobs Act is going to expire at the end of 2025. So I had this whole conversation about taxes, and where do you philosophically land on that? If you feel that the taxes are going to be the same, or if you're going to be in a lower tax bracket, then maybe a Roth conversion isn't as attractive. But for many people, it is attractive, and especially for people with larger estates that they're never going to spend the money. It's about preserving that, minimizing taxes, and having those assets flow down to their family, as tax efficiently as possible. So when you're actually trying to create a retirement distribution plan, you're trying to do multiple things. If you look at Maslow's hierarchy of needs, you got to have a roof over your head and pay the utility bills and your food bills. So you've got to have enough income to maintain your standard of living. The second thing is so the number one thing is that you don't run out of money. Okay, so that's number one. But two, then it's okay, well, I got to make sure that when life throws me curveballs like health issues or something happens or I have a major capital purchase, do I have assets to pay for that? How am I going to pay for increasing healthcare expenses as I age? So we start to kind of build the ladder of the Maslow's hierarchy of needs, and at the top there comes the taxes, and then you have legacy planning or estate planning. And so in the circles that I'm dealing with, we're trying to accomplish many things at one time. How do you take money out? And again, I encourage you to watch the podcast 2, 3, and 4, where we talk about different distribution strategies. But once you figure out the distribution strategies, then how do you do that as tax efficiently as possible? And this is where I quite frankly learned from Andy different distribution strategies on using Social Security. So, one of the things that, again, I encourage you to attend my Social Security workshops, but one of the things that we have in the workshop is an example between the earlies and laters. And by deferring your Social Security to 70, you're getting those delayed retirement credits, you're getting the cost of living adjustments on that. But one thing that people don't realize is that, let's say if I retire at 65 or 66 and I defer Social Security to 70, I got a period of time where I can do Roth conversions on a more tax favorable basis. And the more money that is actually in Roths and also cash value life insurance is also, when we talk about provisional income on how Social Security is taxed, it helps that out. And so people just think about rates of return, but that is so that's one drop of an entire world planet of an ocean. And so, I mean, I'm kind of going down this rabbit hole, but what I'm trying to articulate to our listeners here is that it's really freaking complicated to put all these different pieces together. Just with the Social Security piece, which filing strategy makes the most sense, then you start to layer on taxes and distribution planning and how to pay for healthcare costs, and ultimately how to have the rest of the estate passed to your family on a tax efficient basis. And you can't just do that by a calculator that you find on the Vanguard or Fidelity website, right? And so that again, going back to the points where, I had these clients that referred to me that were working with a good generalist. Again, their portfolios were being managed pretty well. But where those other advisors failed was not addressing all these different things and looking at the complexities of a true retirement income plan. So anyway, I'll get off my soapbox, but I just want to kind of explain that there's a lot of really complex stuff that goes on. And the only way to figure this stuff out is that you have to model it. And so we take your situation, then we have situation A, B, C, and D, because I don't literally know which scenario is best for you. So that's why we model it out. So that's why we model it out before you do anything. So we can see on paper, hey, I like this strategy, I like this and this and this. And so once you go through the process and you compare and contrast different strategies, at that point you say, okay, I think we're going to do this, this, and this, and this. And that's where you kind of go from there, from the implementation stage. But you can't call yourself a true retirement income specialist without going through that process and at least having the conversation about distribution strategies, Social Security, minimizing taxes, legacy planning and estate planning, and all that stuff. So anyway, any thoughts on that, Andy? Because you see thousands of advisors a year. I mean, do you have any kind of thoughts or you want to add to what I just kind of mentioned there?
Yeah, well, I mean, I think I'll go back to the same thing I've been saying since you guys invited me on. It's all about philosophy. So, your philosophy, even though you're not directly articulating it, is your philosophy is to turn over every stone until you find the right plan, until you build the right plan for your client. The general philosophy when it comes to retirement income planning is to take everybody's assets, whatever they've accumulated, and throw it into an asset allocation model and do systematic withdrawals from that asset allocation model. And my concern with that, very simply, is asset allocation, initially known as modern portfolio theory, was introduced by Harry Markowitz in 1952.
Yeah.
So here we are, 2024. We have the first generation retiring in mass that's ultimately responsible for delivering the bulk of their income from the assets they've been able to accumulate. Remember, defined contribution plans replaced pension plans, defined benefit pension plans. So there's a lot of people who have this kind of sense of value in terms of what they have in their 401k plan. They think they're wealthy beyond what they could have ever imagined. What they fail to recognize is that capital has to replace that pension that no longer exists. Well, think about this. In 1952, right, mortality was probably nowhere near what it is today. But beyond that, retirement income planning consisted of two things: Social Security and a pension. That was it. So to invest in the markets was reserved for only the wealthiest people who had disposable income they could invest. And asset allocation of modern portfolio theory was a concept designed for growth investors to minimize the downside while capturing a fair percentage of the upside. Here we are, 72 years later, that same theory is being used to deliver income. So a theory that wasn't created to deliver income is being utilized to deliver income. And what's the impact? The vast majority of Americans, according to the academic world, the vast majority of Americans are crummy savers, and they do not have enough money to retire in the lifestyle they've become accustomed to. But that's only if they don't look beyond asset allocation. You and I, are aligned philosophically because, I believe in a concept I call asset optimization. And asset optimization is a financial planning strategy that's focused not on growth, but on income. And ultimately, how can we deliver the result you want for 50% less capital? And what does that mean to you? It means if you're underfunded, you're now fully funded, not because I picked the right stock, the right bond, the right crypto, but because I'm a specialist. I use every tool available to me in the retirement toolbox to get you the best result. So I can prove to you quantitatively that whether or not you've saved enough money has far less to do with actually how much you've saved and far more to do with who you work with if you come work with me, because I'm going to show you that, yes, if you use a growth strategy, right, masquerading as an income strategy to deliver income, you're going to be underfunded. But if you use an income strategy, a 21st century financial planning strategy designed exclusively for income, I can do the same job for 50% less capital. What does that mean? The vast majority of those people are not going to be underfunded. And the difference between having a safe and successful retirement comes down to who you're working with. Are you working with a specialist or a generalist? Make no mistake about it, the generalist is going to migrate to asset allocation every time because that's the easiest way for them to provide a solution, whether it's the right solution or not. So I went down a rabbit hole too, but that's where I think the difference is. If I'm forced to give you a description of what the difference is between a generalist and a specialist, that's it. The specialist goes above and beyond and finds the solution. By the way, your story, James, is an anomaly because from my experience, the one kind of vertical you can say always embraces the value of a specialist is the medical field. There aren't many general practitioners in their right mind who wouldn't introduce a specialist to address a chronic illness, right? But in the income or in the financial planning space, people don't think twice about, well, I know they have all these added needs and they need twice as much money than they have, but I don't want to, and I don't have to bring in a specialist. So I'm going to try and do it myself. We'll see what happens. Of course, there's no risk to you doing that as the financial advisor. The risk is only to the client. The client assumes all the risk. A specialist takes that risk off the table by not by being better at picking stocks and bonds, but being a better strategist.
Right. And I also want to comment too, it's just like because somebody is a generalist doesn't mean they're a bad person or a bad advisor. Okay. It just means that they just haven't had that training in this specific area. So again, I mean, overall, I love my business and I love advisors. I go to conferences. There's a lot of really good advisors out there, but I think the difference is, and again, I'm reinforcing what you just said, is that you've got to have the specialized training in what you're doing.
And I would say too that for our listeners, for instance, who are they're the ones who are retiring, right? Yeah, a generalist maybe is great when you're in the working years, at least the first set of working years, where you're just trying to accumulate. You're not going to, you know that you're not going to utilize your money for the next 20, 30 or so years. But if you're getting to that stage, whether it's 5 years, 10 years out, or you're right at knocking on the door of retirement, these are things that you should be thinking about, because it's a misconception to think that you're going to pay less taxes. You might not pay less taxes. In fact, you might pay more taxes depending on what you've accumulated and how much your RMDs are and how much, what brackets it pushes you into. So there's so many different facets. The great news, and I guess the purpose of this episode and really this series of episodes, is to arm you with the information to, one, be able to identify the right advisor for you. There's a series of questions you should be asking and a series of things you should be looking for. And we went over those in some of the past episodes. But it's two, you do need to address. And if you're not aware of those, make sure even more so that you sit down with a specialist, because we don't know what we don't know, right? And so you do need to sit down with somebody who does know. And in this case, Jim is a great resource. I highly invite anybody listening to this podcast to go to jimmusgrave.com, schedule a time to meet with Jim, because he is a specialist in income planning. And when you step into the door frame of retirement and the accumulation phase is over, it's no longer about how much money you're going to grow. Obviously, you need your money to grow so that it can last for forever, but there are so many other ways that your assets will be depleted outside of just rate of returns that are so critical for you. Social Security, taxes. I mean, imagine, Andy, you were talking about it, that lady that, because she lost the $36,000 in annual income, she would have had another $1 million. Well, you don't have to worry about that rate of return if you've planned accordingly and have those things in place. And I think the other huge benefit that people have is that it's easy to assume that, well, I'm already at this stage and I don't have enough money. You might have enough. If you sit down with a specialist, they're not just looking at, okay, we need to grow from X amount to 2X amount or 10X amount. It's, what are all the other resources? What are all the other tools out there that can be delivered to help you have the income that you need to live in retirement? So I hope this episode has been very valuable for people. Again, I highly recommend you guys go to jimmusgrave.com, schedule a time to meet with Jim. It's free. There's no obligation to get a second opinion on your guys' scenario. Go meet with him, talk about your written retirement and written income plans if you have one, and he'll help you analyze those and identify if there's any issues that you have, or if you're great and if you're good to go. So go to jimmusgrave.com, schedule time with him, and we'll see you on our next episode.